Bitcoin is the first perfect money, the first monetary instrument in the history of the world that is a properly engineered store of value. The second best money is gold, and the second best money has a half-life of 30 years, and the first best money has a half-life of forever. And so the first best is so much better. Of course, intelligent physicists, economists that understand physics, or capitalists that understand physics are going to discover that. And as they discover that, they're going to buy it and build an industry around it and recapitalize on it. And they're going to draw concentric circles of other investors I basically channel billions of dollars into the Bitcoin ecosystem, Tom, from investors that don't understand Bitcoin. They just want to do convertible arbitrage, or they want to do option trading. There are a lot of people that hate Bitcoin, and they come into the ecosystem because they just want to short my stock. So they short my stock and buy Bitcoin and create demand for Bitcoin, you see. So those are all secondary and tertiary investors. They have capital, they have money, and they want to play some game, whether it's short, long, trading, fixed income. People that have bought my bonds and they just wanted interest on the bonds, and they indirectly funded Bitcoin. So my company is an actor to recruit other investors. Anybody else in the ecosystem is recruiting other investors. But the fundamental physics of this equation is, this is the world's first perfect money. That's Bitcoin, the asset, and Bitcoin, the network, is the greatest global open capital network in the world. It is free digital capital, 24/7, 365. 1,500 crypto exchanges are plugged into it, and it is the number one source of credit, and capital access everywhere in the world right now. And so that's why it is performing. That's why it's attracting capital. And if it is that useful, then a Bloomberg jockey in Singapore is going to raise 20 billion in capital, and they're going to make it available for you to trade one Saturday night, or they're going to make $10 billion of credit available to you on Sunday morning, because they're getting paid an obscene fee to do it. And once you understand the asset's appreciating because it is thermodynamically sound and it represents a lower, more efficient energy state for capital or for money. And once you understand it's volatile because the network is more useful and more leverageable, it is basically the number one. It is the number one source of credit or leverage in the world for everybody all the time. And once you understand it like that, you see the volatility and the performance are a feature of the engineering and the technology. They're not a happenstance. They're not accidental. They're going to continue in the same way that water will flow downhill. And, just like the normie that sees a fire and it's like, I'm going to harness the fire and I'm going to sell it. And the normie goes, well, what if the fire goes out? And the engineer goes, I'm actually going to create a machine, an internal combustion engine with 8 cylinders, and the fire's not going to go out. And don't you see how the 6-year-old Boy Scout, like the fire goes out, and then Henry Ford creates a machine such that the fire doesn't go out? And when you get on a jet airplane and fly across the Atlantic for 12 hours, do you realize that your life depends upon the fire not going out in the jet engine? And you're surely dead. You will freeze to death before you happen to suffocate should that fire go out. And engineers solve that problem for you. And so the difference between fear and risk and anxiety and competence and commitment is understanding the physics and the engineering of the money involved.
When I listen to you, I often get the sense that you really have come to understand the nature of capital flows in a way, certainly as it integrates Bitcoin better than anybody else. And so I feel a bit like I'm talking to the future. So I really do want to map what you just said about it being the physics. So when you say high energy state of money, I assume you mean high entropy, that there's so much chaos happening. The goal would be to get out of a high chaos environment with inflation, money printing, all of the chaos that wreaks on one's ability to store capital. This is where, again, people need to differentiate between currency and capital. So we want to move that into what you're calling a low energy state, but it's basically there are fewer influences on it. It is going to be there. It has the volatility, which we'll get to in a minute, but in terms of a place to store your capital, once you're not in a short-term time horizon, you're in a longer-term time horizon, right. There are just less influences on it. But the siphon effect is capital paying attention. So it will first be smart capital who actually understand what's going on. They'll move first. This is obviously what we're seeing play out. Then all the adoption stacks that you walk people through. And then and this is why I say it's a siphon, it just gets to the point where you can't justify the money not going into it. And so now it's just you no longer need people to understand what's happening, just in the same way that there are bonds of water, there's sort of bonds of narrative about where one should be preserving their capital. And of course, people are still going to preserve their capital in buildings and in art to some extent. You've mapped this out for people. You estimate that, I think I have the exact numbers here, but there's a percentage of capital that people store into. So 450 trillion, this is rough numbers, 450 trillion in assets are held for utility. So buildings, things like that, it's not going to change. But there's 450 trillion, that's long-term capital, pure store of value. And so the siphon becomes, everyone will see over time that by moving out of this chaotic state where there's inflation, et cetera, down into the low energy state of Bitcoin where there is not, that over time, you will approximate, and I don't think you would ever say 100%, but just for simplicity, you will approximate 100% of that long-term store of value capital going to the most efficient, highest return place. And as of today, there's nothing even close to Bitcoin.
I'm not saying 100% of long-term capital becomes Bitcoin. What I'm really saying is long-term capital is like 450 trillion. I think there's 3% entropic lapse. There's 3% loss in that capital every year, either due to inflation or entropy, whether it's a financial asset or it's a physical asset. And that works out to 13 to $15 trillion a year of inefficiency. And that's just people or institutions owning things, and the building falls down, the company fails, right, etc. I think I would liken it to, well, I mean, all the water's in the lake, and all I got to do is carve a channel, and the water's going to flow downhill. And why? Because that's just the law of physics. If I took all your money, like, I don't know, how much of your money do you have stored in a bank in Africa right now, Tom? What percentage
0.
of your wealth? What if I took it?
0.
What if I took it all? What if I'm Dr. Evil and I took all your wealth and I moved it into a random bank in Africa? And then I said, hey, April Fool's, Tom, I moved your money here, but here's the key. You can leave it there or you can move it back to the US. Would you leave it there or might you move it back?
I would be moving it back.
Yeah, but so would I have to force you to move it back? I mean, wouldn't there be a natural tendency on your part to move the money to a place where you feel more secure with the money? Like, human nature is such that there's a lot of people in the world. Do you know that if you went to China and you gave everybody in China the option to move their money to the US, not all of them would, but a lot would, enough so that the Chinese government makes it illegal to do so. Right? The reason there are capital controls, there's a limit of $50,000 a year, is because if people could, they would. So there's a natural tendency of people to want to move their capital from a less secure, more chaotic, more uncertain place, maybe where their property rights are less. I mean, you remember remember in Cuba with the boat people, when everybody wanted to leave Cuba and come to Florida, right? People generally want to move from the less secure to the more secure place They want to move their person. They want to move their money, etc. It's human nature. I think if we come to this siphon analogy, well, there's just so much energy that gets released when you move from an uncertain, unsafe environment to a more certain, safer, more sound environment. That sometimes you don't have to convince people. Like, for example, a lot of times, if the head of the household could leave a war zone, don't you think they'd bring their entire family with them? Like, the kids might not want to go. My dad made me go to places I didn't want to go. You know why? When I was growing up, because his job. You know, how many children go to a place they don't want to go because their parents get a job? They're chasing money, Tom. So people, you know, why did everybody come to the New World? Money. You know, everybody comes up with different ideas. It was all about property rights, and property rights was money. That's why the DuPonts came. That's why everybody came. So generally, you will find, why did people go west? Money. They went west for land. They went west for property. So if you come back to MicroStrategy stock, well, MicroStrategy capitalized on Bitcoin, and our stock started working. So people started buying the stock, and it was volatile. Well, it's so volatile that we have $100 billion options market that's formed on top of our stock. Our company went from $1 billion market cap to $100 billion market cap in 4 years. Our options market went from 0 to $100 billion in 4 years. Our volatility went from 20 or 15, very low vol, to 120. Okay, you can look at that as a negative or a positive, but here's the positive. 120 is like hot money. It's like fast RPM. It's only risk if the volatility comes from doing risky things, if it comes from gambling or doing stupid things. If I go into a casino and I play a game where the odds are against me and I'm winning, well, I'm also going to be volatile, but I'm volatile by taking risk, maybe stupid risk. But if I build a centrifuge or a flywheel and I spin it really hard, I might be volatile. It might look volatile to someone that doesn't understand polar geometries or doesn't understand physics, but it's not risk. It's just a machine that's creating motion or kinetic energy. So when MicroStrategy created that 120 vol, and to be clear for your listeners, to put that in perspective, if you stacked up all of the S&P 500 companies, 120 vol would mean you're the number one most volatile company in the S&P index. Okay.
And just to oversimplify here, or not even oversimplify it, but to state it as plainly as possible, it means that you are doing wild swings up and wild swings down very rapidly.
Yes. Yeah.
In price.
We're oscillating. We're oscillating, and maybe in an unpredictable way. It's like, you know, like if I do this with a piece of balsa wood, it's like a kid's propeller toy, like it's a little toy, you know, maybe those things that scare away the mosquitoes at your tropical barbecue. If I do this with a 5-pound weight, it's a weapon or a weed eater or a lawnmower or something, right? I mean, it's a piece of farm machinery. If I do this with $40 billion, it's a turbine. It might move your jet across the Atlantic Ocean, right? There's 15,000 pounds of thrust in a jet engine, but it's more like a turbine.
Why is it a turbine? What is the God? This is where I don't know physics, but what is the energy output? Is it that money is moving from one person to another? I mean, that's all I think about when I think about volatility. You get one guy panics, he bought high, he sold low. And then the next guy comes in and buys low and sells high. And so one wins, one loses.
If I give you a stock option on the dollar bill and I say, Tom, the dollar bill is 0 volatility, but I'm going to give you an option to buy 10 more dollar bills for $1 for the next year. Well, what is the option worth? It's nothing, right? Because the dollar is going to be worth the dollar. I mean, so a stock option with no volatility is worthless.